you want to raise rents. Well, okay, you better renovate something, right? Well, why? What justifies a higher increase in rents? Typically, it's because you're renovating, making the property look nicer. Let's talk about some of those things. The question really is, well, gosh, how could people have prevented from investing with these operators in Houston where they lost 100% of the capital, which is really, really bad? Because situations like this are always teachable moments. So what I want to talk to you about next is really the questions to ask, the critical questions to ask, and what to look for before investing in your next multifamily syndication, either as an LP or a GP. These questions really are the same, the two sides of the same coin. So I want to speak to you both as a GP and an LP, but the issue is exactly the same. The question to ask is exactly the same. All right, so here are the top questions to ask before investing in your next multifamily deal. Question number one: what kind of debt are you using? If you're the GP, and if you're the LP, then ask the question to the operator: what kind of debt are you using? And you want to know that because it needs to match the kind of business plan that is being proposed. So here's what I mean. Let's say the business plan calls for holding the asset for 10 years. Then a 10 or 12-year fixed term loan is fantastic. On the other hand, if like we do a lot of value add deals, and the plan is to improve the property very significantly, a value add deal, and really the best place to refinance in say 3 years, then a 10-year loan is not going to be good because of the prepayment penalties. This is also why so many operators, including us, did bridge loans, because we're buying more distressed assets. Distressed assets means anything that's occupied under 90%. You need to get some kind of bridge loan. Now we got interest rate caps on that as well. But if I'm doing a 3-year value add and I want to basically refinance, and I'm not going to get a 10-year loan because the prepayment penalties are going to be so high that you can't refinance or sell. And we still, in the early days, we were very proud of ourselves. Like we had locked in super low interest for 12 years, right? But then the markets went up so much and we couldn't sell the daggone thing. We had millions of dollars in prepayment penalties, and we just couldn't make the numbers where we could never sell. We still have the asset. We're waiting for those prepayment penalties to burn off. And so that's awful. So really look at the debt. And of course, if you're using a bridge loan, then make sure that the operator, or if you're the operator yourself, make sure you're purchasing an interest rate cap. Now you could say, well, gosh, how higher can interest rates go? I don't know. But I don't know if you can defend buying a bridge loan right now without buying an interest rate cap. I would work the interest rate cap into the deal, right? So we just closed the deal about 2 months ago, and we paid $2.2 million for a 4-year interest rate cap, right? And our goal is to refinance after 2 to 3 years. And that's very, very expensive. And you could argue, my gosh, why buy an interest rate cap when there's no way the interest rate's going up higher than 2%? You have a good point. But who am I going to speculate on that? If I can make the deal work, then I'm going to do it all day long because it's more conservative that way. So question number one is, what kind of debt am I going to use, and does that match the business plan? Question number two is, to what extent is the property cash flowing from day one? So there's a thing called a debt service coverage ratio, and it's really the ratio of the net operating income to the debt service. In other words, banks want to know that the net operating income is more than your debt service is going to be. In fact, they want it to be 1.25 more. And so that's typically a bank requirement. If the DSCR ratio is lower, the bank will often require that certain interest be paid into escrows to accommodate that difference and to reduce their risk. So if the DSCR is 1.25, then you know that the property is cash flowing from day one, which is good. If it's not cash flowing from day one, it's not the end of the world. It just raises the risk level, right? It's not the same as a multifamily syndication where the cash flow is already positive from day one. So just realize that you're looking for a risk-adjusted return right now, and just know that one multifamily syndication deal is not created equal. There's different variables, right? Obviously, getting a bridge loan and doing a heavy value add deal is riskier than buying a stable asset at 90% and using a Fannie or Freddie Mac loan. Same thing here, right? If the property is cash flowing from day one, that's more conservative, less risky than one that's not. But it's a very important question to ask. Question number three: are there enough reserves? Now, Apple's Way, this is the company that bought this Houston property. It's called Apple's Way. They bought this thing in December of 2021, very end of 21. 6 months later, the pool has been reported according to these articles that you can find. You can just Google 3,200 unit foreclosure Houston, and there's several of them out there. Wall Street Journal has a few and as well, but it appears that about 6 months later, the pool had turned green, trash was piling up, and the Houston mayor threatened legal action against them. Now, how did all of these things happen so quickly, 6 months into a deal? Like, obviously, I'm not privy to the details, but it seems to me that they start running out of money within just a few months of their purchase. Now, how in the world is this possible? This is only possible if they didn't have enough cash reserves at purchase. Now, our rule of thumb when you're purchasing multifamily properties, you should have at least $1,000 per unit in reserves when you buy the property, right? So, 50 units now is you're having, you have $1,000 per unit. So the point is they did not have the cash reserves in place to ride something out. The reason you do it is for kind of things that you don't foresee. So you want to have cash reserves when you go into at closing. And then what you want to do is you want to hold back a cash reserve as you're operating. Again, for emergencies, unforeseens. And our rule of thumb is $250 per unit per year, what we call replacement reserves. And that is basically to build up your cash reserves for emergencies. Now, obviously, if I have to raise more money for cash reserves, that reduces my reduces my purchase price, right? I can't pay as much as the next syndicator who's not doing that. Similar, if I'm not taking $250 per month per year out per unit, then my cash flow is higher and I can pay more. I can overpay, right? So this is an example where you're in your underwriting, you can be more conservative, and you can. So the bottom line is this: you don't ever want to run out of money. That's what happened to this operator. You just don't want to run out of capital, because a lot of things happen, and you can ride them out if you have cash or cash flow coming in. So if you're an LP, these are questions to ask: is how many reserves do you have going into the deal, and what are your replacement reserves, right? And if the operator says, "Well, I don't even know what that is," that again raises the risk level. I'm not saying it's a showstopper, but these are all things in your mind as an investor you're putting together, and you're kind of building in your mind the level of risk in this investment. And if you don't have cash reserves going in it and you're not building up replacement reserves, then the risk is higher. Question number 4 to ask is, does the construction budget support the business plan, right? So if you're a GP, you want to raise rents, well, okay, you better renovate something, right? Well, what justifies a higher increase in rents? Typically, it's because you're renovating, making the property look nicer. Now, it doesn't look like Apple's way. The operator in Houston had a construction budget. Otherwise, they would have had money to fall back on to operate the property, right? So if they're running out of money because they didn't get an interest rate cap, okay, well, they should have had a construction budget. It makes you wonder whether they even planned on improving the property in the first place, right? So how are they going to increase rents and do nothing? Or were they just betting on market appreciation that is outside their control to deliver returns to investors? I don't know what their plan was, but it appears to me if they had a construction budget, they shouldn't have been running out of money 3 to 6 months later. So if the operator has a plan for renting their property, and ask, what is the construction budget, and is that sufficient to execute the plan? In addition to a construction budget that should make sense, does the operator have at least 10% of the construction budget in reserve in case construction costs more? Construction is always more than you think it's going to cost. It's going to take longer. It's always a good measure. If you have $1 million construction budget from your general contractor and or your property manager, well, then gosh, add 10% on top of that for good measure. It's just a good practice. Question number 5 is, how conservative are the underwriting assumptions? Now, I didn't have the benefit of watching Apple's Way presentation to their investors, but I did see one of their cover pages or summary, which advertised an internal rate of return of 20. It was above 20%. I don't remember what it was, like 21 or something percent, which is a really high return for properties purchased during that time. Now, how did they underwrite that deal? Because, what assumptions did they make with regards to rent increases, vacancies, exit cap rates? Because here's the thing, I can make my spreadsheet say anything I want to say, right? So it's important not to pay too much attention to the returns, but to the assumptions behind the returns, right? So this is really important. If you're a GP, is what are your assumptions behind the returns? If you're an LP, look behind the returns, because you're looking for a risk-adjusted return. You have to understand what the risks are. If you understand the level of risk, you understand the assumptions being made. So for example, how realistic are the projected rent increases? Why does the operator believe they can increase the rents as projected, right? Is it because of renovations? What are the comps looking like? Does the story make any kind of sense to you at all?